There's no gurus out there that you can follow and just get rich. Options trading is so easy that anybody could do it.
Rick, what's your overall take on gold?
So let's call $5,000 an ounce the officially desirable price. I think we're going to get there. No one's going to make a case for Bitcoin being worth $108,000.
You're still providing Bitcoin signals.
Bitcoin's moves are very predictable. With my system, the more volatile and violent something is, the easier it is for me to nail the swing highs and lows.
If you were to share two companies,
the answer is Nvidia and Tesla.
Tesla, of all the stuff that happened recently.
I think you could say you ain't seen nothing yet.
Meet Rick Ackerman, a trader who's mastered markets for over 4 decades. From chaotic trading floors to today's digital battlefield. His secret, the hidden pivot method, a visual approach that an English major developed to consistently outsmart Wall Street's quantitative geniuses. In this exclusive interview, Rick reveals why your biggest losses might be your most valuable teachers and how markets aren't just numbers, but living entities driven by human psychology. Ready to see trading through the eyes of a master? Welcome to Golden Meadow, where your investment knowledge and well-being grow together. Join our host, Dominic Staras, as he sits down with Rick Ackerman for this revealing conversation.
You started out on the trading floor, basically, when it was pen and paper, right? And then things started to increasingly shift over to being automated by computers. Then the internet opened up a whole new world of opportunity. So basically, you went through, over the course of your all your time, being involved with the market, a huge range of changes. Maybe you can outline from the moment you started to perhaps mentioning some of the more important changes that you think happened in the markets that you lived through.
I started, I was actually still a newspaper editor at that time, but I was seduced by the easy money, or the appearance of easy money in the options game. And I remember at the time, a lot of brokers, this would have been around 1974 or 5, just after the CBOE opened, and we finally had listed options. And I remember buying Eastman Kodak options because this broker, Herb Gerwitz, called me and said, "Ricky, me boy, there's easy money here." But in retrospect, with all the years I put in on the trading floor and learning about options, the game was so heavily rigged against retail customers then that it was almost criminal. Premiums that retail options traders paid were so juicy that you could not possibly win. So I bought these Eastman Kodak options, and then we've all been in this story ourselves. But a couple weeks later, Consumer Reports came out with a report that the new Kodak instant film, self-developing film that was competing against Polaroid, faded when it got under, in the Consumer Reports test, they put it under intensive fluorescent light. So these options that I paid a ridiculous price for, $300-400 a piece, quickly went down to around 27 cents, and that was it. But I still, I was still eager to learn about options. And again, there was that promise of easy money. So I left my newspaper job and went out to San Francisco in 1978 to lease a seat on the Pacific Stock Exchange.
As the 80s hit, you saw things started to become more automated.
Well, it's interesting when you talk about automation. I did write a piece for Barron's once, and it talked about how when the trading moved from a trading floor to, let's call it upstairs, that the last vestige of honesty in the game would be lost, that the boys upstairs would be more easily able to rig the game because there are no open outcry exchanges anymore. But at the time they were last seen or heard from, this would have been 20 years ago, they were essentially, the market mechanism was the same as had existed hundreds of years earlier when the Dutch settled in New York. They literally would meet on the curb or under the big tree, and they would trade securities. This open outcry system that we use with traders shouting in each other's faces and waving their arms. The purpose of that, when we talk about open outcry, the idea was that if a broker came into the pit to do business, he would have to vocalize, he would have to announce he would call for a market, and everybody would yell the best bid, and they would yell their bid and offer, and the broker would take the best bid and offer. But the idea was that everybody could hear what was going on in the trading pit, and that was the principle of the open outcry auction, and it survived for several hundred years. But as you can imagine, when the exchange volume got up into the zillions per day of shares traded or whatever, this throwback way of doing business, people screaming in each other's faces, represented a bottleneck. You can only
it started to become impractical.
Yeah, it was. The trading pit would have to be much bigger, because when it became completely electronic, people started using electronic day trading platforms. It expanded the network to global. So to duplicate that in an open outcry pit, you need tens of thousands of traders.
What's always fascinated me is how would anybody hear a specific person on that trading floor if everybody was shouting at each other at the same time?
Well, it's interesting that over time, your eyes and your ears tune to the floor. When I first came to the floor as a spectator, I'm looking at the screens and thinking, can these guys actually read that? And then I learned a little bit of how the brain tunes to brokers coming into the pit. I'd be talking with somebody just like we're talking now, and he'd go, so, at a half, and so here we were having a conversation, but his brain had adapted to multitasking in that way. A trader who's been in the pits for a while, he when a broker calls for a market and he's in a conversation with somebody else, his brain instantly picks up the broker's, whatever the broker said. And typically, the Pacific Exchange was kind of I won't call it a backwater, but Chicago was the big time, and the Pacific, kind of minor leagues. It was much more laid back and relaxed than the Chicago pits. And sometimes when these Chicago guys showed up on the Pacific floor, just to do a little R&R or something, they were a breed apart. There was one guy who made his legend. He would stand over a tobacco spittoon, and they were a much tougher crowd, really. So, but the Pacific Exchange was relatively relaxed.
Considering the environment, it was fairly intense, or at least to somebody of my age listening to this, it sounds fairly intense. And of course, my entire image of all of this comes from the movies. I remember Trading Places with
Eddie Murphy.
Eddie Murphy and Eddie Murphy.
Yeah,
and then
it was a good film, though, as far as representing what goes down on the floor.
I think a lot of their view of how they imagine the trading floor to have functioned comes from movies like that, right? And so, do you miss that kind of intensity, or that sort of human dynamic that occurred on the open floor exchange?
I think that that movie gave a pretty good feel. It had a good feel for what goes on the trading floor. It was fictionalized to make things even more dramatic than they are, but there is a lot of drama on the floor. And certainly, if you worked on the Pacific Exchange, your start time was 6:30 in the morning. So you can imagine it's about as sort of high energy a work environment as you could imagine. And you had to be there at 6:30 with the lighting was very bright, very intense, and everybody was screaming in everybody else's faces. If someone got a cold down there, everybody would have the cold inside of 2 or 3 weeks, because you really are. We're literally shouting in each other's faces, and fortunately, the open outcry markets never had to confront the COVID era. The trading pit is not supposed to be a friendly place. we referred to, if there was friendly discussion going on in the pit, the term for that was coffee housing, and but at least in theory, the environment is extremely competitive, and people are not supposed to be just chit chatting down there like as though their business is friendly. It's not. And of course, when the broker comes in, 10 people shout their markets, and there may be 6 or 7 people bidding. We had fraction cents, so 5 or 6 people all bidding 1.5 for something the broker's selling. The broker had to decide, well, you're first. I got 100 of these things to go, and then he'd point to the first person that he heard, which wasn't necessarily that. It could have been the person he most recently had lunch with who bought lunch. So the broker would allocate the 100 contracts among however many people were yelling for them. And frequently you'd get cut out of the trade. There are 100 contracts and 6 or 7 people bidding for them. The first trader has the option of taking as many contracts as that. The first person to be acknowledged by the broker could have taken all 100 contracts. But of course, yeah.
But would there be separate time windows for each sort of type of market? Like, let's say commodities would have their own separate time window in which people would call out.
The orders were constantly coming in. All the firms that transacted the orders, there were customer orders. They would be transmitted to the floor. The broker would take a slip of paper that had the order on it, and he would walk over to the trading pit and just say, it could be a spread order, but the broker would say October 55 calls, Santa Fe calls, or whatever, and everybody would yell. But this goes on all day long, and the brokers are constantly going back and forth between their booths and the trading pits. And of course, Pacific used it was all verbal, but the Chicago Exchange used hand signals. So some of the booths would get the order on the phone, and then they would signal the broker, who would always be standing near the trading pit.
Then the internet happened, right? Well, the 90s is really when retail users started, or rather, people started having the internet accessible in their homes, right? But when did you guys start feeling the effects of this connectivity?
I had left really before it became a factor, but I guess even before the internet, you could say that the securities markets, they were already wired. The internet, the way it changed it, the most significant way, was that it put every Tom, Dick, and Harry in the game. You could be a trader. It wasn't until maybe the mid 1990s that the internet affected anybody we knew. I had left the exchange floor and was a headhunter for a while. And this was before browsers. And everything was sort of telnetted. You'd see on a screen, it was all text. And I was trying to accumulate lists of people looking for certain types of jobs. And there was my first experience with the internet. There was a job market out there. And I called my boss over. I said, Ed, check this out. And even then, you could feel that this was the future of recruiting. What it became the future of, how many other things, it was beyond imagining at that time. This was, again, it was before browsers. And it wasn't until Netscape came along that I guess the public kind of got invited into the world of the internet. But the most significant development that came out of that was that the advent of electronic day trading platforms. So you or I, anybody out there, you could be a gardener or a chef or anything else, you could buy or you could get an electronic day trading platform. The brokers were all offering them, and you could become a trader. So it essentially allowed anybody to get in the game. And of course, the brokers set the rules as far as margin requirements and this and that. And initially, the brokers came into this when there was we still had commission schedules, and in other words, the brokers could make money just from the transactions themselves. But of course, that all died. Schwab kind of broke ranks and said no more commissions. And even though I've been in the business for a long time, I've sort of wondered myself, well, how do they make their money? Um, but anyway, anybody who wanted to trade could trade, and you didn't have to go down on the exchange floor, as I had done in 1978. You could do it right from your home.
So after all this, when do you think you started thinking about your own unique trading method? So we have your hidden pivot method. So let's say I had to briefly describe what a pivot is. I would say that's from what I understand, that's when the price is the area. A pivot is the area where the price reversed or reverses. That's the inflection point, so to speak. But what is a hidden pivot then? Why the name, and what is the mechanism behind it? How did you actually stumble upon it, or what was your journey?
I would say I stumbled on it. I more or less stumbled to it. It's just something that evolved over time. My trading method is very different from anything else you'll find out there because it was all sort of hatched from the brain of an English major. I majored in English Lit in college, so I don't think like a quant really. And my trading system is mostly visual. And all of it comes from an ABCD pattern. You have your AB rally, what I call an impulse leg, BC, which is your corrective phase, and CD is the follow through phase. And ideally and theoretically, in the end, AB should equal CD. And if that's the case, you know exactly where the D target's going to be. Well, I would say that there's nothing magical about my system. If you were to take any indicator at all, if you were to use, let's say, an ADX directional indicator or Bollinger Bands or stochastics or this or that, if you did that day in and day out and you observed chart price action on literally hundreds of thousands of charts, in my case, maybe millions of charts, you get good at it. The use of a system, the purpose of a system is to anchor your observations. And that's really, and any system will get you to that if you look at these charts and your frame of reference has has discipline to it. Then when you watch price action unfold relative to your discipline, that's the way you learn. That's the way you eventually come to read the moves in the market. So no matter what system you start with, if it gives you a fixed, a disciplined observation point over time, you're going to get really, really good with it. And these electronic day trading platforms, which allow me to look at the 1 minute bar charts and 5 and 15, you can see a lot. I mean, there's so much to capture, really. And also, when you have this fixed observation point that a trading system gives you, it helps you to categorize your mistakes. You're not going to learn much from your successes, really. Anytime you make money, I have to say, half jokingly, you're learning the wrong lesson. So, it's the losing trades that you remember, but you're remembering them relative to your ABCDs. And I've noticed also that even the supposedly very sophisticated quants, the room full of Goldman Sachs geniuses, they're not doing anything that you couldn't understand. It turns out that one of the most significant things that can happen on a chart is a trend that goes above a previous peak or below a previous low. And the geniuses are just as sensitized to that small event as you or I would be if we were trading it. So their systems, their huge numbers crunching white box systems, they take their cues really from the same simple stuff that you or I would use.
But so Rick, if you're saying, and I agree with this, if you're saying that we learn the most from not from our successes, but from where we went wrong. Are there any particular instances that stand out where you had some sort of a loss or where you failed at something, and that also contributed to you learning about the psychology of trading?
Well, that's another thing that you get from trading a system. If you're kind of minutely involved in chart price action, um, you are sort of tuned to the psychology of the markets. My system starts with the premise that no profitable trade originates in the comfort zone. So, however much experience you have as a trader, the trades, the ones that are going to make you money, should give you a grinding sense of feeling in your stomach. The comfort zone, to put it in its simplest way, would be this rally. You see this rally unfolding on the screen, and your thought is, well, what's so hard about this? It's going up. I'll buy it and
Hmm.
make money.
Hmm.
I'll buy it at one price. It'll go a little higher and I'll sell it. But when your apprehension of a trend reaches that point where you think buying the uptrend is easy money, 10,000 other people see the same thing. And if they're all acting the same way, they're thinking, well, I'll just jump on this. If they all have that same idea at more or less the same time, it changes the behavior, it changes the price action itself. And so the market, in that sense, is a game where you're trying to second guess the next guy, but he's second guessing the next guy himself. So you wind up, it's a guessing game, second, third, fourth, and fifth guessing each other. And if you were to take the what you see on a chart, something that's the price action that's going up and down and up and down, it's an absolutely perfect analog for mass behavior, for mass psychology. Because if you're trading, let's say, the E-mini S&Ps, we'll take it as a given that there are 10,000 maniacs out there trading that same vehicle, and they all have the same objective. They're going to try to make money by outguessing everybody else as to where the turns are going to come. So there may be 10,000 people trading it, but as you can appreciate, the little dot that represents the price going up, down, it can only be in one place at one time. So, but it is at all times doing the bidding of 10,000 people out there. I don't mean, sorry for the pun. So it becomes, when everybody gets a similar mind, the traders see something that looks pretty obvious to them as a buy or sell opportunity. Um, the more people who share that idea, the more diabolically
Hmm.
evasive the little dot becomes. There's no crazy in my technical method. To me, it's all impulse legs. It's just an A-B trend leg that got past two prior peaks, and I try to simplify the price action.
So if institutions are driving the markets, right? If we take that, that little Wall Street cheat sheet, where you have the cycle displayed, and you have retail investors usually, or traders usually buying when the professionals or institutions are actually selling or getting ready to sell. If the institutions are buying, for example, at a stage two of, like, let's say, an uptrend, and selling earlier than retail does, um, how much of that kind of stuff is factored into the hidden pivot method? Is anything when it comes to the psychology of trading?
I like to think that the white box traders and Goldman Sachs room full of quants, they may think they're in charge, but to me, there are bigger mysterious forces that really control price action ultimately, and that these guys don't know it. They may think that they're in charge, but they really aren't. And I find that my own method can identify swing highs and lows that the room full of quants doesn't see. How do I know that? Because the trades work. I have what's called a voodoo trade, where
Wow.
uh, where something will reverse on a chart in a seemingly crazy place. There's no reason for it, but my system has been able to discern a very precise reason for it. And it's only something you could arrive at if you start with a visual frame of reference for your system. I'm just, as I said, just an English major, and it's all about pattern recognition. But I see things happen on the charts, and I do trade what I mentioned earlier, the discomfort zone, and I feel like I can get a jump on professionals who use very large, that use thinking machines. I used to teach a few courses in trading. I've stopped doing that really because I think some of the ideas are really too valuable to retail, and I'm just using it to trade. But the voodoo number is a very cool little trick, and there are just a few other tricks that you use that just they work. But my kind of overarching view and the way I write about the markets is to treat them as a sleazy carnival midway. I've been in all aspects of the business. I even worked for a company that did research reports that they sold to institutional investors for six figures. It was called Grassroots Research, and they used kind of a Madison Avenue model to develop reports that there were never reports to sell things. It was just a justification for buying this stock or that. And I did it during the dot-com era. But I've seen all aspects of the business really, and I would say the minute-to-minute trading is just it is a carnival midway. It's a big sleazy game, and I don't think a trade ever happens down there that's not being front run by some institution. In other words, they Goldman Sachs. Oh, I shouldn't name names, but they may have a customer who has told them, look, I want to acquire 30 million shares of Apple over the next 3 or 4 days. And so the firm will get in there and they'll do everything they can to take advantage of this bid that's going to make the stock more buoyant than usual. So that's called front running. And I think pretty much every trade that goes down on the floor is being front run.
Doesn't really matter that much what we small retail investors do, really, right?
Well, we get in between the cracks, and I know someone who's doing that with options. Like if you look at an options, like a level 2 screen that shows you constant flux of bids and offers, and sometimes you'll see really huge numbers. There'll be 16,000 contracts offered at $1.37, and those are machine bids and offers, and the machines don't intend to trade that kind of size will only trade if they're doing something against it. But if you have there's 16,000 of these offered at $1.37, you can't bid $1.31 and get them. They have to come to you. They're not going to hit your bid. So I have a way of anticipating. Their machines know where they can trade these things advantageously, usually within a hedge relationship and arbitrage. But my method tells me where they're going to offer it eventually. Even they don't know that, really. It has to do with what other opportunities are out there.
But it's interesting the way you talk about it. It's almost like there's some sort of mystical aspect to the markets, actually. Do you think there is? Because you said there are other forces at work. Do you think there's some sort of mystical aspect to this?
Most surely. And the way I explained it
That's interesting.
when I first started teaching a trading course, was I couldn't exactly explain it because, as I'm saying, it is somewhat mysterious. But if you take the basic ABCD pattern, the market in its ups and downs is a living, breathing thing. And I made that point earlier about how the price action itself really is volitional. It's something. It's a trading vehicle doing the bidding of all these people who are in the game. So it's a real thing. In the end, you'll see, and if you have an ABCD pattern that you use or some other system, you'll see that there are points in the ups and downs where you have equilibrium. And I think the markets are always trying to find equilibrium, a place where, in theory, there are no bids or offers. Everybody's perfectly happy with that price, and no one thinks there's any advantage buying it there or selling it there. But to take a step back, as these vehicles, trading vehicles, fluctuate, they're always seeking equilibrium. And my analogy was to the breathing process. You inhale and you exhale, but in the end, you can't do more of one than the other. You're the outgoing eventually equals incoming. So if you put that in the context of price action, you've got all the jiggles and jaggles. And my theory was and is that for every jiggle on a chart, there's a corresponding jaggle, and it represents the jiggle as a form of energy. And at some other place in the chart, it may be well to the right of the jiggle. You'll find a jaggle that balance the energy.
It's almost like listening to string theory or something like that. Wow, that's interesting, man.
My
Interesting.
ABCD
Yeah.
method, really, seeing every trade, every possibility, all price action in the context of my particular pattern, A, B, C, D. That just organizes the jiggles and jaggles so that they're visually available, that they're easily discernible.
Rick, when you're offering these in the chat on Golden Meadow, for example, um, or in your analyses, you don't really provide straightforward buy and sell signals. Why is it? Is it because you want to empower people by having them learn how to read the charts with, for example, the hidden pivot method and then spot the patterns?
That's part of it.
Mm-hmm.
I have taped to my wall a statement from Lefevre attributed to the Jesse Livermore character. So I don't remember the exact quote, but it's no, sir. If you tell me that someone that blindly following someone else's advice is going to make me more money than my own good judgment, well, that's just crazy. So I don't think there's such a thing. There's no gurus out there that you can follow and just get rich. You really have to put some of your own thought and effort and your own discernment into it, and your risk management. And that's what I encourage, really. I'll give out the rods and reels, but I'm kind of sparing with the fish. But to sort of get into the more technical area of how I forecast and recommend, some of my recommendations will have what I would call excessive risk. But I have a way of cutting down the risk that I call camouflage. I'm looking for buy or sell signals that occur in the context of big patterns with commensurately big stop losses. So there's a lot of risk in these trades. So the camouflage technique simply takes the signal, the buy signal from a big chart, and at that point, you drop down to the 1 or the 3 or the 5-minute chart, and you find a corresponding ABCD pattern, a tiny one, and you use that to trigger your entry. You take the buy signal from that tiny chart with its commensurately tiny stop loss, and that's the way I cut risk on a trade. There may be, I think I've got a yen trade in play right now at Golden Meadow, and the dollar risk is pretty large. But I could cut it down by 95% simply by doing the setting up what I just mentioned, the camouflage trigger. So in order for me to sort of describe a camouflage trigger to a Golden Meadow subscriber, it would not only take 200 words in a chart to do it initially, but it might be pegged to a particular low that gets taken out by a tick, and then I've got to undo the whole thing. It changes all my parameters. So it's work, and it requires intensive focus to cut the risk of the trade down. And if I'm going to do all that, I may as well just be trading. I can't. I found I can't do both, really. I can't be sort of bringing people into a trade and doing all the minutia that will cut the risk down and do the trade myself. I miss out on the trade if I'm keeping someone else on top of it. Just 5 words of explanation is really that 1/3 of a second that you're losing, and you can't even get that. You don't want to be that far behind a trade. So it's kind of it's a dilemma and kind of a paradox to be able to guide people into a trade the way I do it, which is extremely risk averse. I think that you should make money on every trade, even the ones where you're wrong. And the method that I use allows you to do that, but it's a bit labor intensive.
Would you say that the hidden pivot method is suitable for novice traders? Is it thus making it useful to everybody, or do you find that most of those people who subscribe to your product are those who already have some years of experience?
That's an interesting question that I've had to deal with it for years and years. Um,
Mhm.
my method has gotten the rudiments of my system have gotten simpler and simpler over the years. The trading course that I used to give around the world live was 2 days. It was a 16-hour course, two full days. But I've reduced it to the point where I could tell you basically what I'm doing in about 12 minutes. So I could give you I could teach you kind of everything you need to know in 15 minutes.
I'm not sure I
But
could understand that.
well, it's very simple.
Mhm.
However, there are nuances which help you to reduce risk and help you to determine better opportunities.
It takes maybe 15 minutes for you to explain the concept. However, it takes quite many hours to actually understand and apply.
Right. And I would say that I'm finding that doesn't hold true for options trading. Options trading, uh, done the way I'm doing it, is so easy that anybody could do it. And I would kind of, if I were to teach them how, I would push everything that they think they need to know about options out of the way and concentrate on just a few things. They're really, really basic, and you don't have to know about options. You don't even have to know what a put or call is. You're just catching right on that dot as it moves around. But the
And
options is in another category, and
and this is
I
using the hidden pivot method.
yes, yeah,
Yes.
very directly, and in a way, a simple way that even it took me a while to realize how simple it was. And it's first of all, it's a directional system. And most professionals or friends of mine who've written books on options, of which I have many, would say, oh, he can't do that. There's no way you can get an edge trading options directionally, but they're wrong, as I've discovered. A good trader, somebody who's traded options all his life, would say you can't do it, but I'm doing it. And it's just not that difficult.
So would you say that the hidden pivot method, Rick, is especially suited for options?
Well, I like to say that it's especially suited for idiots like me. I mean, I think an English major only has half a brain to begin with, and and so I didn't really come at it. I never did the math really, and I know some really good quantitative traders who do really well. But I would say it takes much too much work. They're putting a lot too much into it, and as far as how much they make for the amount of risk they take, which is expressed as something called a Sharpe ratio, I would say my Sharpe ratio is quite a bit better than theirs, but it is work intensive,
Mhm.
and with the options, my goal is to get my work day down to about 10 or 15 minutes. I think you can do that. And I would also say to people who have 8 screens and they're trading 6 things at the same time, it doesn't really, to me, it doesn't suit the objective of simply making money.
Rick, what's your overall take on gold? And I know that's a very broad question, so let me narrow it down just slightly. Um, do you stand anywhere on the spectrum? Because from what I understand, or from what I see, is that you're not really a gold bug. You're more of a pragmatist when it comes to gold. Considering the geopolitical events right now, a lot of people are wondering why then is gold not skyrocketing, for example, right?
I've always been a gold bull, but not of gold's going to $50,000 an ounce bull. I think that's crazy. And I think that no matter what happens, inflation, deflation, Armageddon, um, gold will hold its purchasing power. So So, and as far as gold going to 50,000 or 100,000, I suppose it's possible in a short squeeze scenario where there's a squeeze on all these paper. There's obviously a lot more paper gold out there than there is the real thing. The paper guys have had one good thing going for them. That is that the government backs them in a conspiratorial way. The regulators have made it possible to gin up infinite quantities of paper gold, and that has always had the effect of suppressing the price of physical. You hear that Trump's number for gold is 5,000. Trump is in a process of remonetizing the dollar, taking U.S. assets and leveraging them to so that we can pay off student debt and do this and do that. So Trump has taken the position the U.S. has assets, let's use them. And in his businessman's way, he's saying let's put them in hock, and that includes your home. The part of a Trump plan is that he's going to borrow against your home equity. And as crazy as that sounds, if they give you an interest-bearing certificate, but that's partly redeemable in gold, as skeptical as I am, I think I would take a look at it if this piece of paper is backed by gold. So I think, and this is just something I heard or read about at some point, the valuation at which gold becomes useful becomes the quantity that the U.S. possesses, assuming it's still there in Fort Knox, could be significant in a workout for the U.S. is about $5,000 an ounce. So let's call $5,000 an ounce the officially desirable price. I think we're going to get there. So I remain bullish. And of course, we're going through a period now where there's not enough story really to drive gold. And because it's so closely controlled by sleazy institutional players, particularly bullion bankers who can effectively borrow as much gold as they want for nothing. It's the character of its ups and downs is directly tied to what you would call institutional opportunity, which means basically they want to bring it down if they're going to buy it. But you should make no mistake, every sovereign entity on this planet is buying gold either surreptitiously or they're buying it wide out in the open. But all the players, every sovereign fund is buying gold. And if you see it come down like it's down $31 today, it's because they want it down. They want to buy it. They want to bring it down, buy it at relative bargain prices before they run it back up again. So it's entirely manipulated. It's really controlled. Yeah. As far as why it's not the last time it really responded in a way that to geopolitical crisis in a way that may have gratified the gold bugs was you probably have to go back to 1960, whenever it was that the Russian tanks rolled into Czechoslovakia. But as much as we're thinking, my God, we're like 2 steps away from thermonuclear war right now. Why doesn't gold do something? Gold's become very, I'm from Missouri. Show me. I'm not going to react. I'm not going to get all nervous about something. If we see a mushroom cloud billowing over wherever, then gold has a reason to take off, because the whole infrastructure of our banking system is about to go kaput. And speaking of going kaput, if it goes kaput because of, let's say, electromagnetic pulse, it's not going to be a Bitcoin world. And these people who say, I'll change my gold for your Bitcoin anytime, they're out of their minds, because Bitcoin it's a fraud. And I don't care who I'm arguing with that about it. Just no one's going to make a case for Bitcoin being worth $108,000 per copy. I'm good for maybe it's worth $3.28 because of the ability of the blockchain to securely record a transaction. So I like gold.
Yet you're still providing Bitcoin signals. Right?
I do that. I came to Golden Meadow and hope that you could find me some of these young people, these Robin Hoodies. As far as I'm concerned, they're very underserved by technical analysis. Bitcoin's moves are very predictable. With my system, the more volatile and violent something is, the easier it is for me to nail the swing highs and lows. I just had a Bitcoin trade the other day where we got in on what I showed as a green line, and it had a very quick $1,400 move.
Because you call Bitcoin a fraud. I'm not saying I disagree, I agree or disagree, Rick, but for example, if something has real world applicability, so Bitcoin is based on blockchain technology, and I don't want to get into the specifics of all this, but if something has real world applicability, because in this case it does to some extent, barring all the all the controversy around it, still, if it does have that real world applicability, doesn't that mean that it has some fundamentals?
Yeah, it's got value. Earlier, I gave you the figure of
Mhm.
$3.28, maybe. I sat down with a quantitatively adroit friend of mine, and we decided that the value of Bitcoin for transaction purposes it's a few bucks. Of course, nobody uses it for transactions. I would say 90% of Bitcoin use, or probably more, is pure speculation. That's all. But I say it's a fraud because it's trading at $109,000 as we speak. There's nothing behind it. And even when the big guys, when they argue for Bitcoin, they bullet point their arguments. The bullet points are scarcity, 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 scarcity. And of course, that goes back to the 21 million Satoshi mintage, which did cap Bitcoin. But so what? If all the other the scarcity is not does not give anything the quality of money or even value. So I'm just not a. But the fact that I'm not a buyer of the Bitcoin story, I forecast it simply because I can do it with astounding accuracy.
What about silver? What you were saying previously about gold, does that also
So
apply similarly to silver?
silver is so punk. I mean, the sovereign entities that are doing all the buying, they don't even think about silver. It's not in their universe. It's not. So what happens is gold enjoys the institutional sponsorship, and silver is still it's just an industrial metal.
Yeah,
It's
because I mean, technically, it has a lot more applicability in terms of industry use than gold does, and that is a fact. And a lot of people get excited about silver, myself included, and they like it, and they would like to see it rise in price. Are you also bullish on silver?
Yeah, I mean, when you get the ratio gold silver so out of whack is to generate a multiple ratio of more than 100 to 1. That's just crazy. So eventually, gold will keep silver from falling too far, but eventually, silver, the poor man's metal, is going to take off and lead the way. It will be the price will be considered speculatively excessive relative to gold.
Rick, if you were to share uh, two companies that you think are worth looking into, not as quick trades, but more along the lines of a short-term investment, because perhaps they're undervalued. But you would say, based on your research, based on your experience, that they have serious potential in the near future. Is there anything that you think stands out?
I hate to come back with such a boring answer, but the answer is Nvidia and Tesla. You
Tesla,
know,
of all the
t-
stuff that happened recently.
I hate Tesla's car business. I really do. I think that all of the $135,000 dual motor drive Plaid, they're all going to wind up in a landfill or as paperweights or something. They really are.
Yeah.
I'm very bearish on electric vehicles, but Tesla is so much. It's a much bigger company than that. And you look at these stocks and you think, God, they've already split 10-for-1 or whatever, and they're pricey even now after the split. But I remember thinking the same thing about Microsoft, which Microsoft was one of the Pacific Exchange vehicles that I traded. Pacific Exchange had the secondary listing in that stock. And I remember thinking at $88, who would buy it? I mean, that's crazy. It's just so pricey at that level, but it's 100 times that now. So you really have to sort of open your imagination to the possibilities down the road. That Nvidia is the champion at not only exploiting these unlimited vistas, but actually in creating them. So Nvidia may seem pricey now, especially when you take it you take the split out of the pricing, but it's I think you could say you ain't seen nothing yet.
If you want to dive deeper into Rick's world and learn his legendary techniques firsthand, you can join now for a 7-day free trial and test Rick's gold and Bitcoin radar on Golden Meadow. Just click on the link below this video. Rick loves to share his knowledge. As a subscriber, you'll receive Rick's real-time market analysis, learn the hidden pivot method through practical application, and get exclusive trading suggestions from one of the most accurate forecasters in the business. Don't just watch from the sidelines. Join the community where investing expertise meets personal growth.